Warning: all values used in this video do not reflect actual market rates or averages and are only used for the sake of explanation.
Investing in mutual funds made easy. Hello everyone. Today I will try to explain mutual funds in the easiest way possible. But before understanding mutual funds, you need to have an idea about how the stock market works. Well, the stock market is where people buy and sell shares or stocks. But let's not get too technical. What is a share or stock? Well, I will explain it in a very easy scenario. Let's say Mike wanted to open a grocery store, but he doesn't have enough money. The grocery store requires $10,000, but Mike only has $5,000. So he calls his family and his in-laws and he tells them about his idea. His family trusts him and know that he is a very disciplined and hard-working guy. Mike managed to convince 5 family members to invest in his idea. Each family member gave him $1,000. Mike gave each of them a special bracelet. The bracelet represents their share at the grocery store. Each bracelet means the person wearing it have 10% of the grocery store, and by the end of the year he gets 10% of the store profit. If Mike made $100,000 profit, each one of the 5 family members who contributed to the opening of the store gets 10% of the profit. So $100,000 multiplied by 10% equals $10,000 for each one of the 5 family members. That $10,000 represents their dividend. It's like a compensation Mike pays for his 5 family members because they have let him use their money. And they will always own 10% of the store and get a part of the profits each year. Now, what if one of the family members no longer wants to be a part of Mike's grocery store? I mean, he does own 10% of the store after all. Let's say the brother-in-law no longer wants to be the part of the project. He still owns 10% because he paid $1,000 at the start. He have a bracelet, it represents his 10% of the store. In this case, the bracelet is a metaphor for the share or the stock. So, the brother-in-law decided to sell his bracelet, in other words, his share, to a friend. But since the store is making a lot of money and profits, it's now worth way more than the $10,000 it started with. Now, it have more capital and funds. It's making a lot of profits each year. The grocery store is now worth easily $100,000, which means that the brother-in-law 10% share of it is worth $10,000. So he sells his share for $10,000 and now he have made $9,000 profit on it, since he bought it at first for $1,000. Now what if the grocery store didn't work out and Mike wasn't able to pay his debt and he only had a few clients each month? And that would mean the business didn't work out well and the store that requires $10,000 to open and that was its capital. But now he didn't make any money and he spent a lot and he's still in debt. He only have $1,000. The store value is estimated at $1,000. So if the brother-in-law wanted to sell his share, which represents 10% of the store, he can sell it for $100 since the store is only worth $1,000. This is the stock market. An investment can be profitable if the company is becoming more valuable. So you can get dividends yearly, or at the end you can sell the share for a price higher than at which you bought it. Or you can make a bad investment and sell the share for less than you bought it, because the whole company is not worth much now. And it's hard for a regular Joe like you and me to know what company is going to be a good investment or not. This is where a mutual fund comes in. Let's say you heard about Mike's grocery store and you wanted to take part in a similar situation, but you don't know how to do it and you are afraid to lose your money. Well, a mutual fund is basically people giving their money to an expert stock trader, someone who knows what opportunities will turn out well and which one to avoid. And with his experience, he will invest in multiple companies with the money people gave him. The sum of that money is called a fund, and that's what a mutual fund means. It's a sum of money that belongs to multiple people who want to invest in good opportunities but don't know how to. So someone does it for them for a certain commission or fee. Also, mutual funds are not as risky as investing your money in just one company, because the stock trader expert will invest in multiple companies. Let's say our expert is named Jim, and he created a fund composed of $8,000. That mutual fund is made by 4 people, each one of them gave Jim $2,000 to invest for them. Jim found some good opportunities like Mike's grocery store, and by the end of the year he made a nice profit of $2,000. Now, since he invested with 4 people money and each of them owned 25% of the fund, they would all receive some profit. Now $2,000 multiplied by 25% equals $500 for each of them. After that, Jim gets a little commission or fee for making the right investment for you. This fee or commission depends on the company. Now, there are multiple types of funds, but the safest choice will be the index fund because it invests in big companies such as Google and Apple and Microsoft. These companies are not risky and they can be also quite rewarding. Now, the only problem with the mutual funds is that they depend on stock market. And by stock market we mean big companies like Microsoft and Apple. If this company's stock goes up, they will follow, but they will also go down in case it goes down as well. That's why mutual funds are a great choice for people who plan on long-term investments. However, if you want to make some quick profits, your choice should be hedge funds. Also, here's a very important detail. Hedge funds require a huge load of money. However, for a mutual fund, you can start with a small amount, even $100. So if you're starting to invest and you don't have a large sum of money, mutual funds are a great choice for you, because they have a low fee for managing your money, and also they are practically a basket of big established companies such as Microsoft, Apple, Ford. So basically, if you invest $1,000 in index funds, your money will be split even between all these companies that exist in that certain fund. Now, if these companies perform well, the index fund will grow and your small part in that index will grow as well, and you will make a small profit. Index funds are a great way to start investing at a young age without any experience. Remember that the longer you keep your money in the fund, the more money you will make. Let's say you invested $1,000 in index fund. By the end of the year, you made 10% interest, and now you have $1,100. Let's say next year you make another 10% in profits. Now you made $111, and your other part in index fund went from $1,000 to $1,200. Well, this is a little trick known as compound interest. I hope this video was a little bit informative for you. Also, you need to remember that all of these are just examples. It's really rare to make 10% interest in an index fund, but with time, you will make a nice profit out of it. Patience and compound interest are your friend. Also, if you liked this video, please drop a like and subscribe to the channel for more content like this.